And why market buying based on the future? You buy for the future, right? You buy Tesla stock because you feel future, this stock going doing well, this company going to doing well. That's what you think going to be. That's why it is very important, our expectation. All right. So therefore, this one actually really do not want to talk about stock. Use stock as an example, as a case to go to expectation theory. Okay. So let's go there first of all. So let's see the stock then. We have to understand fundamental stock, right? So here give you very simple, and you can still doing this, but it's not really reality. It's not that simple. Okay, you pricing stock cannot be this simple, but then just use a simple way to analysis. So this is one period, how to value stock. Okay, so this is dividend, one period less than 1 year. You hold the stock 1 year. So at the end of 1 year, during this 1 year, you got a dividend. Okay, so it's a dividend one. And the end of the one period, less than 1 year, you're selling this stock. Okay. Remember, P0 is today's price, the current price. So obviously, you are assuming you can selling P1 at P1, right? P1. So dividend normally you know, because the company is rarely change dividend strategy unless economic recession or booming, so adjust upward. But normally they hold the dividend the payout ratio. So normally it's okay, but do not change it that much, okay? But the P1, you really have to be anticipated. What's the price you can sell? Let's say you buy Apple stock 120 today. You expect it 1 year later, next year, March, you can sell in 200. Are you sure? So now here trying to say is, assuming you know, you do the homework and you can forecast that you'll be able to selling at a P1 that price, okay? So if we do know all those cash flow, this is cash flow, right? Selling, you get money in, is cash flow. Dividend, you get a pay dividend, you get a cash flow. Now, another thing is K. So KE is expected, okay? So means now real expectation, you estimated that. So what's this one? This one is required rate of return. Okay, so here's the case, okay? Can be, remember we mentioned interest rate can be so many, can be treasury bill, treasury bond, treasury notes, could be corporate, but why it is required rate of return on this stock? If this Apple, it's Apple's required rate of return. If it is GM, this is GM's required rate of return. Each company have their own yield. This is yield to maturity that way, if you can estimate it, but it's not yield to maturity. Yield to maturity measure the bond. You can say Apple bond, so that's yield to maturity. But this not, this a measure stock. So you're gonna learn in the future 4,000 level finance investment, we're gonna be totally working just how to analysis get this one, required rate of return, okay? But in here, we just give to you. We just give to say, okay, this is a company, if you invest in Apple stock or GE stock, this is GE's required rate of return based on GE's risk, based on GE's all information, okay, let's give to you. Then you can discount GE's dividend and you sell in the stock, discount back, get a present value. And that's one period stock, you can estimate it. You can see the simple model. I already said you're assuming so many things. Assuming price, you can selling at the P1, what's the price? You're assuming you know KE, and then you can get this one period stock price, okay? So let's do the exercise, very simple. Okay, let's do the exercise. So assuming, just use that formula, okay? So the formula is P0 today equal to the dividend cash flow, any cash flow, right? So dividend plus price you're selling, price P1, okay, next period, and divide by required rate of return, right? Discount back, that's interest rate, right? So basically it's expectation that the required rate of return. So that's the one period, just holding one period and you're selling. Okay, so I give you example. So if dividend, you're holding this one period Apple stock equal to $2 dividend, you receive it, now you're selling it. and you receive it, then you estimate it, you can sell it by end of this 1 year. Let's say you can sell it at 150, okay? And then your estimated or research company reported to you say required return of Apple is 0. Not use percentage, okay? Let's say it's 5%, okay? So now you can figure out. So based on those information, what's the Apple price should be?
$144.76.
Okay, let me write down what it says. 144.
144.76.
76. You agree, everybody? Okay. Okay, so you agree, right? I need one confirmation. No?
Yeah, I agree.
You agree? Very good. Okay, otherwise I have to do it. Okay, good. So we got this number, okay? Okay, now what I mean though, this number. So let's say if stock right now trading at, that's right now, I'm giving example. So let's say if right now P0 trading at equal to, just like today, maybe 121. Oh, sorry, 121. Okay. And then you say today should be equal to 144. What I mean? Tell me what I mean. Why we have two prices here? Today's stock trading at 121. Okay, hypothetical. No, real. This is not real. Our analysis is 144. Today should be trading at 144. What are you gonna do? Assuming you do right. Okay, assuming dividend you got this right. Assuming the KE you do research accuracy. Okay, you get this value. So what's the, how to interpret what's going on here?
The stock is undervalued.
Mm-hmm. What do you do then?
Yeah, so I would just buy the stock and hold it and until it gets corrected again and make the money.
Thank you. Thank you. Very good. Yes. Okay. That means we're assuming based on you say you do research, everything do right, and then this is supposed to be fair value because this is your research value. Okay. Market oversold. Market was just like couple weeks ago. Market oversold. Your pricing is showing you the reasonable one. Fair value means you do all the homework should be at 144. Market trading 121 means stock is oversold. Then you should buy, right? It's buy low, right? So this is cheaper, compare fair value. So it will go back to the fair value. If it's trading higher than this, you should short because like I said, the condition is assuming you do the right thing, get this right, get a dividend right, get the price you're selling P1 right. So then you will make this decision. Okay, very good. The one pair stock. So give you a very simple one. All right. So let's we go to difficult one. So one pair stock, this is easy to understand. So now go to real, right? What if I'm not just holding 1 year? Many people buy the stock holding, couple years, several years, so long period. So fundamental same logic, right? You get a cash flow. So the D1, D2, so all those period, let's say you're holding 10 years. So you're going to have a 10 period, right? And at the end of 10 years, you're going to sell in the stock. Let me say this once again. 10 years later, can you estimate the 10 year what the price you can selling at the PN, selling that price? Can you now today estimate you can sell it at the PN? Is that okay? Can we estimate that? So means no, very difficult. Okay, impossible. You don't even know tomorrow was the price. How could you know 10 years later? Anything can happen. So this price very difficult. So that means all this formula looks so simple. You can do it look like it, but you don't have really accuracy. So that means this is difficult. Okay. And then you had to estimate this all 10 years, this KE over the 10 year, how that change, change, adjust, whatever. So it's not that easy, but formula look like easy, but now reality, right? So now watching, because this last term is far away, okay? So means you remember we learned time value money. This is so far let's say you discount this money back to today's value, this one contributed to the total your present value very small. The longer, the more small, right? Remember time value to teach you. So you wanted today's $100 better today. 1 year from now will be less, right? Because discount back. So actually, it's a good thing is you don't need to bother about this one. Too far away, I don't even need to bother. Why? Because of far away. I do one more exercise. We did this before, right? Do this how you see this far away, this distance, okay? Go back as we did it before. Let's say this is 10 years later, you will be selling this stock, be able to selling at, let's say 100, okay? You estimated that 10 years later, okay? N equal to 10, N equal to 10. Okay, still let's use our KE equal to 5%. Then you do it, just calculate this cash flow. So what's this $100 today's value? So you just, I just want you to worry about this cash flow, just see what's this cash flow's present value. So P0 of this cash flow, 100 divided by 1 plus 0.05 and n power and 10 power 10. So equal to what? Anybody working on that?
$61.39.
$51.19.
61.
61. Okay, 61.39. Thank you.
Yep.
Okay, so well, still bigger, right? So let's do more.
Professor?
Okay, yeah, go ahead.
Can you explain how you got this equation, this last one, P0 equals 100?
I just tell you do that. What do you mean? Okay, I say it's okay because this last 10 years later, let's say hypothetically, you can sell in $100 per share. I just want to say whether this price is significant enough to keep it. I give it. It's not the equation at all. So 100 divided by 1. Let me write down. You want me write? That's what it means. Want me write down the equation?
Is it the same equation as before? As the
No,
one-year
it's not. It's
evaluation?
not. It's not. Just last piece equation. Okay, let me go back. I want you hold on. Where it is? I want you just see this piece. Just this piece. This equation here. Ignore this one. Just want you to do this one. I want you to see the n is longer and the more you can ignore it. Means this p is difficult to get value. So that's why. Okay. So let's go back again because this is not significant small. So you cannot say professor we ignore it. So let's go one more exercise. Okay. I want you to choose. I'm not 10 years now. Okay. Now let's say 100. Let's say what? Let's say it's 50 years. Okay. So change the n equal to 50, 50. I want you looking at the direction. Look at it. So do one more time. If n equal to 50, so let's say 50 years later, you still see whether how small it is. Whole point we're trying to say is if we go to infinity, go too many years, you don't need to bother about last term. Do one more time. What's the result?
$8.72.
Very good. So we're going which way small? Very good. $8.72.
Yes.
Okay, good. Okay, so now like you see the trend. So that means you don't need to, if you go to infinity, go to longer, see that's what I did, okay? If you go to infinity, you don't need to bother this term. So all the dividend add up. I want to give you a hint one more time. If we use a generalized dividend valuation model, this is the model, right? How to calculate the Google stock, Twitter stock, Facebook stock, how? Can you do that? Can you do that? Very simple question. The exam will say, okay, can you use the model to evaluate the Google stock, Facebook, Twitter?
Assuming that the dividend is given until infinity.
Huh?
assuming that the dividend will be paid out until
also pay each period pay until to, if let's say now infinity just said many years, right? Right now, so far I do 50 years. You already see the stock $100 worth to $8. You can ignore. Let's say if 100 years, so still 100 years give a dividend. Yeah, we have those old companies, 100-year company do pay the dividend. Okay, answer my question.
yes, I think.
What's that? Okay, yeah. Who said that? Tell me how to do it.
Okay, I think you would just divide the dividend by your required return rate of
Okay,
that makes-
okay. I said that because I thought about Google, Facebook. Do they pay dividend?
No, they don't.
They don't. Exactly. That's what. It's not your fault. Okay, I'm trying to just. That's why I
Okay,
choose
so
them.
you were specifically talking about Google and Facebook.
Yes,
Okay. Oh,
exactly. Yeah, it's not just any stock. I see what you mean. Yes, because those growth stock, they don't pay dividend. Can we use this model?
No.
No, right? Yes, no. So this model is very fundamental, very good. See, makes sense, right? Future cash flow discount back. That's how we learn. But you cannot do because Google do not pay a dividend, so you cannot do that. Okay. Then I'm curious about you. You tell me now how are you going to value Google then?
How well, Professor?
I said okay. I said now I'm curious. How are you going to value Google stock then?
Based on their projected future profits.
Okay, future what? Very important that word. Go ahead again. Say one more time.
Based on their projected future profits.
Okay, very good. Earnings. Very good. Okay, good. Okay. Future earnings and future cash flows means project of future. For example, Apple, right? Future, next year they couldn't selling 200 million iPhone, hypothetical. They have nothing else, only iPhone. Then each phone $1,000. So then 200 million phone, you know how much money they can selling. And that's their cash flow. That's what their cash flow. Then you subtract their cost, everything can become a net earning. Okay, and then you can base on this project. That's what they do. Okay, they did that. That's what the fundamental analysis. Okay, so we cannot base on dividend. Very good. Okay, good. So this is just give you some idea. Still, this model we cannot use it for certain stock, for even dividend stock. You still cannot. Can you do this 1 year, 2 years, 3 year, for 30 year discount back?
No.
No, exactly. No, the fundamental good, theoretical good, beautiful, but we cannot use it. Okay, that's it. You cannot pricing. So that's we had to go next one. Now, golden growth model makes things better. Okay. So formula is so simple, okay? So golden growth, that's just analysis formula. Now we introduce how he got this way, okay? So now he did a good job. He did analysis. His model only is, okay, so the dividend, today's stock, okay, P0. And next dividend, 1 year later or 1 period later, that dividend, okay? Now we know that one. And then we know required rate of return and growth rate, the company growth, right? So you know that. So now use that one easy to the formula. But this have condition. Okay, let me talk about the golden growth. This have assumption, so clean, so simple model, but this assuming the corporation, the firm who have the dividend, the company growing at a constant growth speed, growth rate at G. And that's how that works. Let me show you here. Okay, so how the golden growth model so clean, but golden growth assuming this way. Okay, so this is 1 period, 2 period, n period. So each period, so this is dividend 1. Okay, so D1. Okay, this today is 0. Okay, so this is T0 here, T0. So you need to know today. This is very important, and you're very soon going to confuse because today is very important. Okay, we're pricing P0 as today present value. Then you can make a decision. Should I buy or sell? Today, make an excellent decision based on future what's look like. Okay, so dividend 1. So then dividend 2, the equal to dividend 2 equal to dividend 1. okay, and then multiply 1 plus G growth rate, okay? So that's what he assuming, constant growth, okay? Same thing, you can figure out dividend 3, okay? Let me ask you, what's the dividend 3 can be? So from here, that's logic. So what's the dividend 3 can be? I type in here because I don't have space there. So D3 should be equal to D2, right? Multiply 1 plus G, okay? 1 plus growth rate, okay? So because of that, so we can say equal to D1, you tell me, equal to D1, then multiply 1 plus G what? G what?
Squared.
Very good. Yes, square. Okay, very good. So that means you continue going on. You do this way, do all the way dn. Here's dn dividend. So should be equal to d. Let me use d1. Okay, d1. Sorry, d1. Yeah, d1. Okay, multiply 1 plus g n minus 1. Right. So that's n minus 1. Okay, good. See. So now you figure out all the dividend, okay? Then you're solving that the formula.
Professor, why it's n minus 1?
Because you're watching here, let's go back. See here, see D3 is 2, right? Power. So when n equal to 3, so n minus 1, right? So when n is n, so that's n minus 1. You agree? Yes or no?
No.
You're not? Okay, let me draw it here. Okay, see, this is dn. dn is 3. So then this n is 1 is equal to 2, right? N minus 1, right? You agree?
Yes.
Okay, and then if it is 2, then this is 1. So if n equal to 2, then it's n minus 1. You agree?
Yeah.
Okay, good. All right, let's end. So what I'm saying is you based on this golden growth model, you go back to that formula, okay? You're solving this formula because this n all becoming equation of d1 now. And then forget the last term, use this one, right? Forget last term means equal to 0, mean almost irrelevant, too small. Don't bother about that, go to infinity, okay? So just like this, then you're solving this equation, you can solve in this equation, okay? And then you get this. Okay, so condition is this company must be at a constant growth. They're growing, each year they're growing 5%, every year 5% forever, infinity, okay? If that's the case, this model is perfect. You can price in stock, just need the next pair dividend, then you need a growth rate and you need a required rate of return. All right, so that's simple now. Once we got the formula, it's very, very simple. So let's try to practice, okay? Before we do practice, go ahead.
Growth rate will be given to us?
Growth rate, company growing, if in exam can be like this one, okay? In this equation, can be anything, right? It can be, if I ask you price, can be have to, in the one equation, only can have one unknown. So give you growth, you can get a price. But what if they give you a price, say what's the stock trading at, give you dividend, give you required rate of return, you have to ask your question about the growth rate. You can solve in that, right? Because yeah, just one variable. Yes. Okay. So yeah. So now we have the golden goal. I'm gonna ask you a question now. Look at this formula, so simple, but do you know what's the condition we cannot use this model? Look at the formula.
If the growth rate is not constant.
Yeah, that's for sure, right? If the growth is not constant, I will very soon showing you multi-stage, right? So let's do it right now. Okay, now constant, you cannot do that. Very good. What else?
If
Just-
the dividend is not given, most recent dividend is not given to us?
So that means if you do not know dividend.
Yes.
Okay, so yeah, so if you do not know dividend, or if the stock do not pay dividend, if the stock not pay dividend, like I said, go back Facebook, they don't pay dividend. Can you use this model?
No.
No. Okay, good. So if you don't pay dividend, cannot use it. If not growth, constant growth, do not use it. What else? Look at the formula. What else you cannot do it?
Okay, so I see on the denominator here,
Uh-huh.
if the growth rate is higher than the required rate of return, then the
Uh-huh.
formula won't be able to work anymore.
Yeah, why? Very good though. Why? So if he said if this growth rate higher than required rate of return, so denominator is negative. So why? What happened? Why not working? Very good question though. Why? Why it's not working? I just want to challenge you. Why not working? So let's go back. Let's see what you guys thinking. Let's do the numbers, okay? The numbers speak loud and clear. Let's do it again. Use the formula. Let me type in the formula first for you. Okay. Present value of stock equal to next period dividend, right? And divided by, required rate of return, okay, minus the growth rate. Okay. Very good. He answered very good though, but we want to challenge you. Say why though? Let's say dividend equal to $2. So
Because
go
dividends
ahead.
gonna be, because
Go
you
ahead.
can't take back dividends, because it's gonna be negative, the dividends.
No. Dividend give $2. I'm give you dividend $2.
Okay.
Let's say
So stock price
PE.
negative.
You spot stock price negative. What happened? What happened? Good. Who said that?
So the
But,
company is bankrupt if the stock price is negative.
the negative bankrupt. Very good. I wanted to hear you guys' story. Very good. Okay. Even negative stock price, it will be bankrupt. Okay, that's fine. What do you say? Okay, 6%. So yeah. All right. So you say stock's negative. So stock negative, what happened? You said bankrupt. Never. Did you ever see stock negative?
Nope, cannot go under zero.
Exactly. It cannot go to zero, cannot go to below zero, right? Remember we said shareholders have limited liabilities, cannot go knock your door, say you need to bring back, if a Tesla collapse and stock go to zero, but you say go to negative, then you go to your house, say you have share of Tesla, so you need to give money to us because your company bankrupt. And so it cannot never go to negative, go to zero, that'd be good enough, right? That's why limited liability corporation, your owner, remember your owner, so only limited to the stock value, not to go to all the way to your house. So cannot be negative. So that means if like this case, you cannot use the model, that's all. Remember, theoretical is theoretical, reality is the world, real world. If in this case, you cannot use the model, simple. This model too good to be true means like only certain thing you can use it. Otherwise, you cannot. In this case, you cannot use it. Means the company growing so fast, okay, and require rate of returns lower than that. In that case, you cannot use it. It's just a very, very simple answer. Means you can't. What else you cannot? Let me clean up. See, look at formula again. Just to make sure the formula is so clear, so simple, then too good to be true. Must be have a lot of constrained condition. So what else can I do? What else? So we say negative not working, no dividend not working. But what else?
They can't equal each other.
They cannot equal. Why?
You'll get zero.
So if they equal zero, then they equal to zero, then what? Like dividend equal to zero, dividend divided by zero. So P zero, very good. Just follow me. What then what?
It's an error. It's going to become an error.
Become an error. Because this is not the case. You can use it because this is like become an error in your system. It's technically it's infinity, impossible. So that means it cannot be zero, cannot be. So that means if they equal, you cannot say this stock trading at infinity. You say, I don't care because my formula tell me so. So that should be equal to infinity. No. So that means this condition also cannot use. Very good, okay? So when you eliminate out those conditions, you cannot use the formula, then you just cannot use it. It cannot evaluate in that kind of stock. Any stock, if you have that kind of situation, you cannot use the formula, although the formula is so simple, so good. But however, the formula have the assumption, that's why we get this one, okay? But in general, the companies, you know, what very fast growing stocks, normally they also risky, like startup, right? Startup is very fast growing, but then they are also very risky. Very risky means pricing in here require the return very high. So normally short term is okay. Short term you can get this higher than this one in general. Then they slow down, then become a multi-period formula calculation. That would be difficult. I think I will introduce one simple multi-period. Okay, so now since you're pretty good, okay, so far you're pretty good. Let's do one more analysis, okay? Do the multi-period. Just use this as example. Follow me, okay? This is difficult. If you can solve it, you solve it. Don't solve and go home, figure out, okay? Let's say if the company growing in this way, next year, in the first 2 years, they in the one growth rate, okay? So that's G1. Let's just put one here. So one growth rate, I will give you a number. And then after this two, so 1 period, 2 period, so that's a 1 year, 2 year, okay? After that, at a D3, okay, they're gonna grow in different speed. So D3 will be like this. So equal to, okay, so equal to D2, right? Always growing from previous one, right? So multiply 1 plus G2, okay? Then going forward forever means indefinite, okay? You even can go to 3 stages. Let's just go to 2 stages. Then you got a sense of what's going on. So what I mean, let's say, hypothetical, let's say G1 equal to, I'm gonna give you a number. So say, assuming G1, your company start up growing very fast. In the beginning, it's 8% growth rate, okay? And then after that, companies slow down because who can grow that fast, right? So G2 equal to 5%, okay? And then assuming company require rate of return KE equal to 10%, all right? So now can you figure out, let's say this again, okay, very difficult. So in the beginning, the company in this 2 period, 1 and 2 here, it is the company growing at G1, okay? G1 equal to this number. After that, starting from D3, just 3 years later, the starting growing at G2, slow down. And at this slower speed growth will be stayed here indefinitely. Okay, or infinity or forever. You see those words, it means infinity. But so you know that means you're going to use golden growth model. So from here, rest of this period, you can try to solve and use golden growth model. Remember, golden growth model is infinity, forever at that growth rate. If infinity at that growth G2, that means I give you a hint, okay? So that means you can use this P, I just say P, I say 2, I already give you too much information, okay? Equal to D3, okay? And divide by KE minus G2, okay? That's P2. U care is about P0 because that's what it is here. U care is here. Here's P0. You want to know this stock today, what it should be? P0. But I give formula P3 because P3 is here, okay? That means P2 is here, okay? P2 is here. At here, P2. See whether you can figure. Somebody's good. I want you to figure out, okay? P2 is here. So P2, I give you a formula already. I tell you from here point over. So next P2 is the next dividend D3. So golden growth model because you told me go to forever. So that's what it is, golden growth model. But I got a P2. So can you figure out P0? Anybody can think of it. You don't have to give a number. You just give me about what do you think of the formula. That'd be good. Or just tell me what do you think, and I will know. This is multi-period. The more you're doing this way, the more close to real.
Professor?
Yeah.
Yeah, so I think,
Mm-hmm.
or I would do this in 2 steps.
Okay.
So all the way to D2,
Uh-huh.
since I have, the dividends, and then I have the growth rate,
Uh-huh.
and it's finite. So I'll just do D2
Mm-hmm.
over KE minus G1.
I do it for you. Okay. KE minus G1. Okay.
Yeah, and that'll
What's this story though? What I'm just typing, what I mean though. So
that means part of P0.
okay, part of the pizza. So what's this? Yeah, part of that. But what is coming from? This is what I mean. What I mean. You part. Okay, go ahead. You finish it. Okay, then I do you another part, and you finish it.
Yeah,
See.
and then the second part, I would get, like you said, P3, P2.
Okay, just use a P2. Okay, P2.
Yeah, doing P3 over KE
Right.
minus G2.
Okay.
Yeah.
Right.
And
Just
then
use
I
P2.
would discount that P2 back to P0.
P2 discount by the P0. Okay,
Yeah.
so 1 plus KE. What's the power there?
Okay, so I would discount it 2 periods back.
Is 2, right? Okay. That part is right. Okay, then what? So they see you have this, you have this.
Yeah, and then I can add both of them up.
Okay, don't too fast. You do a good job. You do a good job, but not perfect yet. Okay, do a good job. This one you cannot add in yet. You know why? Because this is present value, right? This is not present value. That's why I asked you, what's this, right? Remember? I know you're trying to say something, but you're not there yet. So think again. Well, so just see here. I'll give you a numerical number, make your life easy, okay? Give you a dividend of 1, give you a dividend of 1 equal to $5. D1 equal to $5, okay? So here's the case, okay? Just watching our time value. This is dividend 1 cash flow, you know it's $5. So this is cash flow, right? So this is also cash flow. This is $5. What's this one? You give to me. So this you know now. What's this one? $5 multiply what? 1.808, right? So equal to what? Give me number. So dividend equals to, I do it, okay? Equal to 5 multiply 1 plus 0.08, right? Gross add. So G1, okay?
5.4.
Equal to what?
5.4.
5.4. Yes? Okay, good. Thank you. Okay, so you have dividend 1, dividend 2. Look, this is cash flow. Today's here. So this is cash flow, this is cash flow, and then P2. Now I give a lot of hint. Do you get a P1, P0 idea? He did the right thing. He did a good thing is he did this one's right. Okay. But what about dividend 1 and dividend 2 though? We still have that cash flow. Now easy. I already said so many things, right? Okay. So now I don't ask you anymore. I just do it. Okay. So now very good job. Okay. So now you're just missing here. I put it here. So P0 should be equal to dividend 1. Dividend 1. I know the cash flow, we got it. So we got a 1 year, got a dividend of 1. So we just discount that dividend 1. That's cash flow we know. 1 period. And plus we have dividend 2. We know it's our cash flow 2. So discount back. 1 plus KE and 2 power. Okay. So that's 2 cash flow. So this is present value, this is present, and this is also present value. So all add in safe now. Remember I said all present value, now you can add. So now this is becoming multi-period. So this 2-period, you just based on fundamental analysis, which is, you have dividend cash flow, get today's value, and it's P2, take care of all the rest of cash flow. You already use a golden growth model. So just get this value, and this value is at time P2, T2. So today's value, at the price of P2, this is today's value. So then safe to adding is stock price. You okay so far? This is multi-period. This is a little difficult, but it just add on some cash flow, remember time value money, add on cash flow. So this will become a multi-stage. You can add on more other stages. So you can do more, but at least you're okay on this one so far? Any question here?
Yes,
Go ahead.
Professor.
Yeah.
Can you explain again the second part of the equation? Why is it P2 divided by?
Okay, this is a very important piece. Okay, so I hope my slides is not messy. If messy, let me know. Okay, so let me remove out this D3. I want to type in it so make you feel comfortable here. D3. Okay, so that's okay. Just typing it. Okay, so here's the P2. P2, okay, and then here's D3, okay. Remember P0 is here today. You want to figure out all the rest of the cash flows, today's value, that's P0, okay? So 1 period later, you got dividend, okay? And next period, you got dividend 2, so you got dividend, okay? So after this, dividend 3 and 4, 5, 6, they all growing at G2. They are the speed. Now at the first one is fast growing. After that, they're growing different one. So that's why after that's at P2. So D3 is G different now. This D2. Okay. So D3 is here. D3 is here. See? Okay. So D3 based on D2 and growing in second speed. Now like this one is G1. So from here, so that means you have all different, so all the G2, right? So the rest of that is actually you can use a golden growth model, which is constant growth at G2, okay? Based on that model is dividend 1, then this is P0. But right now we're trying to say this is dividend 3. So this have to be P2. Right? Remember formula. Formula is very clear. Say this is P0 and this is the dividend. Where's my now this formula? Where's formula here? You know what? I'm retyping the formula. Okay, formula trying to say is so P0 equal to D1 divided by KE minus G. Okay, this is the model. So that's why we're trying to use this model again, but a different time period. So at the time 0, then it's next dividend. Same thing at P2, then it's next dividend, okay? So because this change the dividend speed growth, so that's why we want to pricing the rest of that. So that's why we're going to choose at a time P2 moment, what's the rest of this patent money worth it? Is worth P2. Okay, but once we know this value, it's not today's value. We had to discount back to today. That's why P2 discount factor here. So we clear now?
Then shouldn't P2 be D3?
P2 is this one, remember? This is P2, because golden growth model, remember? So this is golden growth model. P2 is D3, right. So that, yeah, P2. So put the P2 here, okay?
Oh, I see.
Yeah, and then you will have the full picture. So yeah, just step by step, the rest of it based on new speed and get the value. Yeah, okay. So very good. Okay, so this is the just a little bit little complex, a little bit, just, but then if you get this logic, you get it. Otherwise, you go to home, do a little bit more practical, okay? So let me go to, so we finished the golden growth model. Why we cannot go to that slides? Let me see. Go here. Okay, so that's golden growth model. And I also showing you the speed. Now we're done. See, with stock price, we finished. Okay, so you see how difficult pricing stock. Now we finished already. So we did argue those. Okay, we argue stock, how you're going to pricing, left, right, and the final use the golden growth model. But the golden growth model have the condition. You cannot just use it. Okay, so we're moving to next level. Next level say, okay, we know the stock price. Now what I'm trying to say is how the market set the price. How they set up the price. Okay, so the first one tell you say it's set by you, by buyers. Really? Did you feel Apple stock is you make decision? So how come they say the stock is selling by the buyer? Buyer willing to pay the highest price means anything. If we go to Apple store, buy the iPhone selling $900. You said it's $900. Is I selling it or you selling it? How come the iPhone is selling by the buyer willing to pay the highest price? Can you, how to interpret this logic here?
I will say, go ahead.
Right.
If there is only one iPhone left, right, then you will start bidding for it, and the person willing to pay the highest price will get it.
Exactly. Otherwise, didn't sell. Didn't sell means, okay, didn't sell means the Apple, no matter what they sell, how much money, all is just the parts, nothing selling, no money, no cannot selling it. So have to be highest willing to pay, right? For example, let me give example. Very good. Okay, thank you. Very good. For example, that's Apple. Very greedy. Okay, they come out of the iPhone new version and then they're selling at $1,200 one unit of the new phone. Nobody buy. You don't buy, I don't buy. Nobody buy. They couldn't sell. Even they couldn't sell, and those things are becoming material or useless and becoming warehouse, inventory. Now money cash out. That means trouble. Okay, they cannot do that. They have to sell. So then what happened? $1,200 per unit. Then they know, okay, nobody want. I'm dropping the price, 1,100. Still nobody want to buy. They had to dropping to 1,000. No one to take it. Exactly. Finally, drop to 900. The buyer willing to pay the highest prices. So drop it to 900. This is becoming the highest price the buyer willing to pay. That's it. The lowest fine, but the highest one, 900. So finally, we have people bitter. Means like he said, have somebody want to buy this price. So you can see the rich people or high-end people will buy high-end product because that's the highest they're willing to pay. And that's what some people are starting to offer the money and buy the item. So then settle $900 per unit. If Apple want to selling more, they have to reduce more price at let the middle class people to buy too. So that's why you can see Apple have a iWatch, so many versions, so many price labels, and iPhone, so many price labels, this model, that model. They just want to say, okay, rich level, middle class, student, a lot of things they label it. Yes, that's the whole point. It is, right? So that's good. It is the highest price the buyer willing to pay. So it's the buyer setting up the price. Okay, very good. We argue. That's a good job. So market price will be set by buyer. We know now that can take a best advantage of asset. How come? So let's say you just say, finally, drop it to 900, and then people jump in and say, okay, 900 is reasonable. I will buy. Because that buyer must be understand, say this based on what all the information in. They know inside or outside technology. Let's say they know the iPhone glasses, how much it costs, $10. Then assembling in overseas, how much it costs. And then they put it all together. They say, okay, iPhone best should be selling at 900. Cannot be more than that. It doesn't make sense if we're selling 1,000. That's what it means. The people, the buyer, have all the information. They get all the best information. They analysis, they feel 900 is the fair price, and then they offer it. Otherwise, they don't. They feel this outrageous price like that way, okay? And they won't. So that's why it is is set by the buyer who can take the best advantage of the assets. Means they have knowledge on this assets, so that's why they take action. Okay, so now becoming knowledge important, right? So now next one, so superior information. So you have a lot of information, but you have the best one, or only you have superior information about an asset can increase value by reduce its perceived risk. So how are you going to interpret that? So what I mean this one, what I mean, can see you link to anywhere, can link stock, can link to iPhone, link anything. How you interpret this as superior information? What I mean this sentence?
So since the price is set by the buyer willing to pay the highest price, now let's come back to the to having only one iPhone that we were bidding for. If I have no use for the iPhone, if I don't know what to do with it, I'll be using it as a paper press. Then I will not be willing to pay as much as somebody who needs it for business, or his business will go down. So the person who needs the asset the most and can squeeze the most value out of it will be willing to pay the most, and in turn will be setting the price.
Okay. All right. That's one way to can be interpreted that way. Here's about the what do you think about the risk? Okay. Superior information means if you have the best information, then others have it. You have it. Okay. So, but inside out. Let's use this iPhone again. If I have a knowledge engineer, I know how technology or know all things, how that works, and then I see this phone, what's could be the worst case scenario, what could be the problem, what could be causing, let's say, camera is not good, could be dropped water, everything. I understand that, then I have this knowledge. So that's therefore I already know based on this price, it's a good deal. Okay, because I already think about all the risk factors. Let's say other phone, they drop to the water, they immediately dead, but this phone drop water can survive. So I know all the risk factor, everything based on all the things. I have this knowledge, superior information means I have a better than your knowledge way. Now I understand the risk. I see the risk already based on risk factor. Already this is a good deal. That's why this is good buy. So that's why those superior information very, very important. So that's why this buyer sufficient enough. So that he's seeing 900 is good deal. That's why he buy. Okay, so that's what I mean. Superior information. He already consider about all the possible risk factors. That means he understands the risk, everything he pricing in, and he said, okay, 900 is a good deal. So that's why it's important on knowledge and on information. So we go back here. So information, right? We all know information. Basically, everything trading is information, right? Your stock, if you know some stocks say, okay, they have a new technology, new IPO, whatever information you know, then you will know that the price will going up because information just becoming very, very, very popular right now. One thing I want to link to your real world, we're all doing these vaccines, all before doing tests, right? Tests are you positive or negative, this is a bug, right? So, a lot of Walgreens, CVS, all those pharmaceutical collect your data, my data, whoever doing that, your own personal data. So end up in their hands, right? So those information very valuable, very valuable. They can marketing based on those data. This, remember this whole world, everybody going to be vaccinated, going to be tested. It's a lot of data, armies data, data mining right now. And then they can use the data. People even just like you go to the Robinhood, how do they make money for free for you? They're selling data, selling you data, trading volume, trading data. So data very, very important. Okay, so information is so important. For right now, it's even more important because once they collect those data, they can analyze your pattern, what do you like to buy, follow you, and marketing, right? So now we go to information here, right? So we know information is very, very important, even in the market, in everywhere. Okay. But information keep changing, keep updating. You say, okay, stock market, why keep updated, keep changing any moment, any second? Because new information keep floating, keep going on. Today, if you say, oh, we have more kids, the bug, okay, the kids coming more, and the market not happy, or job data not good, or the Fed says something, or the world have some problem, okay? So a lot of things, those new info keep flowing. Then people have to adjust it. Remember we mentioned about high frequency trading, those hedge funds, the computer, all the computer analysis, those data now, not just you and me, our mind maybe quickly thinking, but we do not action. But they are doing trading, they do action, right? Quickly they calculate this information and they just trigger, say, buy, sell, whatever, right? Just like you see in the market a couple of days ago, couple of weeks, just down, because just that day auction 7 years treasury security didn't selling well. Remember I say when the auction is borrow money, keep borrowing, now showing you bond market not happy. And the stock market just feel something going on. Stock market very sensitive. Any information just affect them, So information and new information coming, and people will be adjusted, digested, and expected, keep going on, right? If Fed say inflation, we're going to expect it, pricing in inflation, all right? So that's all there. So it's very important. Okay. So that's the new information, and we adjust it. So market participation, like you and me, okay? We are constantly receiving information. Like I say, if you have broker account, when you open account, you just see the information can flow in. Right now, I think we are overwhelming killed by information. If you really follow information, you cannot do anything. You cannot finish the reading whole information, too much, a lot of. So that's why I need a computer to data mining analysis, okay? So constantly receive information, and then we have to revise about whether we got it. But because too many information become a noise, so now becoming whether we may put a garbage in our analysis, even in the computer, maybe put a bad information, not good information. You do not know now because so many, okay? So we have the revised expectation. I think a couple of weeks just talk like that, just too much, too over bearish on the bond situation. Just people do not know how to digest it, just like that way. Okay, so that's why stock price change frequently, any moment, any second changed. Okay, that's why you have to long-term investor, because if it's short-term, you're gonna crazy, right? So that's you understand easy now here. Okay. What about this? We're going to use this model, golden growth model, to do this analysis, okay? So remember we have a global financial crisis like 2007, okay? Let's use this golden growth model. What I mean, because if it's a model, we all use it, then this model should be able to interpret about the real world, what happened. So let's use that model again. Let me type in the model again. Use the formal one. P0 equal to D1 divided by required rate of return, KE, minus growth rate, okay? So let's say, just the same thing, this logic you're gonna use it, okay? If 2007 happened to 2008, okay, 08. The period, let's assuming right now that we time traveling go back. Assuming right now is 2007, just right about the financial crisis, okay? So at that moment, you tell me, let's choose one variable. You tell me G, what happened to G? Means
G became very low or went down.
Very good. G going down. So growth rate will drop. Why? Why growth rate dropped if financial crisis coming, if recession coming? Why growth lower?
Money's leaving the market?
Money leaving the market, financial crisis, yeah. So just think about what's growth. What do you mean the growth? It's a corporation, right? We talk about, let's say, Apple stock, Apple company. So if a financial crisis coming, Apple growth going up or going down?
Maybe they're not investing enough.
Who now invest enough? Let's say again, okay, focus on, let's say corporation, let's say Apple. We just focus one company. Can company going up or going down if financial crisis coming or if it's recession coming?
Going down.
So went down. Why? Why Apple growth going down? Why?
I think there are
Mm,
many factors.
Go
I
ahead.
think the corporation is not investing in new investment.
Okay, when recession coming, a company now invest on new investment. Okay, so they're now going to invest. What else can be?
Yeah, and I think since the economy is contracting, consumers are willing to spend on those products.
Okay, just go back again. Go back again. I say very simple. You're selling Apple iPhone. Okay, you recession coming. Can you selling that many phone before I say selling 200 million? Can you in recession selling 200 million? Are you gonna buy in recession?
No.
No, nobody buy. Why? Because recession. Maybe not that many people buy. Oh, hold on. What is that?
People do not have money to spend.
Exactly. So in a recession, people lose a job. Rich people maybe buy, but the total number will drop compared before recession. That's what we say recession, right? Crisis means people lose a job, people cannot buy home, cannot pay the mortgage, cannot buy food. How could it be they buy the luxury phone? Then people will say, I will delay, I'm not updating my phone, not buy. So compared to before, selling 200 million phone right now dropped, selling maybe 100 million on the rich people buy it, but it's still dropped. So that's why you cannot selling more, you drop it. So that's why the Apple's company's growth rate will drop. So same thing, Apple, Google, Facebook, everybody else will drop, same logic, right? Very good. So during the financial crisis or during recession, growth rate will drop. Okay, good. If G dropped, what happened to P0? What happened to P0? So now we do a good job to analyze G. Now what happened to P? P0 equal to what happened? What direction? Up or down?
Down.
Yes, going down. Thank you. Why? Watching the formula. See formula. If G going down, this is negative, okay? And it's the denominator. So you know what? I just give you numerical. If you cannot see clear, let's say you do numerical, dividend equal to 2, just hypothetical, not changing. Okay. Let's say required rate of return equal to 0.1, 10%. Okay. Before is growth rate at 0.5. Okay. Okay. So now before, okay, this is before. Now you tell me it's dropped. So equal to 2 divided by 0.1, assuming nothing else changes. So equal to 0.4 dropped, 4. Okay, so now you know what's the price. The price, see the negative, right? And you dropped. So now before is 0.5 in the denominator. Right now it's 0.6. So 2 divided by 0.6 compared to 2 divided by 0.5. Obviously, price going up or going down? I already did this analysis. Compare this. This is equal to 2 divided by 0.5. 0.5. And the other one, 2 divided by 0.6. So this one is dropped. So P dropped or go, I already said. P dropped or going up?
Professor, is that supposed to be 0.5 or 0.05?
0.05. Thank you. No wonder you don't say anything. Okay, 0.05. Okay, yeah. Well, otherwise totally wrong. Okay, let me remove it. So many things. Very good. Okay, so let me redo it again. Don't do it again. Just you tell me what's about the P. So G dropped. Well, I removed the formula. So use this formula here. So if G dropped, what happened to P0 with stock price? Huh? I do this example.
It won't go down.
It's going down. Yes. See, remember this one dropped and it's negative. In the denominator, I give you numerical, so maybe we should do that numerical again. Okay, let's do one more time. So P0, okay? P0 equal to $2 dividend without change, assuming not changed, and then 0.1, 10% required rate. I typo this wrong. Okay, so 5% growth rate the first times. Second times, so 2 divided by 0.1 minus 0.04 because dropped. So this one equal to 2 divided by 0.06. The other one, this one equal to 2 divided 0.05. You tell me the second one is lower or first one is lower?
Second one is lower.
Second one is lower, yes. So that means when company growth dropped, the price stock will drop too. So that's why during the financial crisis, stock market tumbling because all the stock like this, stock price dropped. And that's why tumbling, okay? So that's good. So G we tested, okay? We tested G, say if G dropped, then it is true. So that means this model did a good job, okay, so far. So let me ask you second variable. So G we done, okay? What about the K? So during the financial crisis, the old recession, what happened to GE? But not GE, KE here. What happened to KE during the financial crisis? Means going down, going up.
Up.
Going up, why? Very good, thank you. Why?
Because people are more, they're risk averse and the riskiness of the assets increase.
Hold on, calm down a little bit. You do right, okay? But key is what? Is companies require rate of return.
Yeah.
Okay, so let's say Apple. So Apple, it's the Apple's required rate of return. So you say this is going up, but why Apple require rate of return going up during the recession?
Because people are more concerned about them because they're not that able to sell phones anymore.
Okay, so phone dropped, then what happened?
Well, because the growth rate went down,
yeah,
the required rate of return had to go up to compensate for it.
Forget it, don't go that far. We done this growth analysis. Okay, this is difficult part, okay? Let me say it again. Remember what's the required rate of return? Required rate of return is, because you never learn this, of course. Required rate when you go to a 4,000 level, you really use CAP model or other arbitrary model to learn how to get this right, okay? This required rate of return, why I call required, means based on the company's risk. If the Apple and the GE compare, if GE more risky than Apple, then GE's required rate of return should be higher because they are more risky. So that's why required rate of return, when risk are coming, this go to the roof. This is going upward when the risk are coming, okay? So similar link to high yield, like a year to maturity that way, okay? But year to maturity only measure the company's bond yield that moment. So if you're looking at the corporation's capital structure, they have bond and equity. If bond yield going up, means the company risky, your stock will risk come up too. That means this guy require rate of return going up. So this one is require rate of return reflecting company's risk. So when macroeconomy risky coming up, doesn't matter how good the company, you will go follow with the market. So this risk will going up. Are you clear about this? Required rate of return is associated with the, the market risk, right? So this is regarding to companies based on the risk you required should give me a return this much. That's why I call required rate of return. Okay. So when risk coming, this is going up because the company have risky. Everybody is risky when the financial crisis coming because who knows who's gonna fail. So that's why going up. So then if this one going up, you see P going down. Okay, here, same thing, P going down. We'll continue argue about this one. Since we delayed to March 18, that's why I have more time. That's why I'm talking more detail here, more argument. I ask you time answer or waiting for you, so I have time. So that's good. But at least now you know the midterm will be 18, okay, March 18. Okay, we stop here. We'll talk about next time. All right. Have a good night. You have a question?